The crypto world just witnessed one of its most shocking events, a staggering 19 billion market crash that wiped out billions in value within hours. Traders, investors, and even large institutions were left stunned as Bitcoin, Ethereum, and dozens of top altcoins plunged simultaneously. But the real question echoing across the market is, who is behind this Ninocene crypto crash? Was it market manipulation, a black swan event, or something much deeper and more coordinated? In this detailed analysis, we'll break down what really happened, who might be responsible, and what this means for the future of the crypto market in 2025 and beyond. Let's start with what actually happened. Over the course of just 36 hours, the total cryptocurrency market capitalization dropped from 2.41 trillion to 2.22 trillion, erasing nearly 19 billion. Bitcoin lost around 8% of its value, falling below a key psychological level that many analysts believed was strong support. Ethereum fell by 6%, Solana by 12%, and newer Layer 1 projects like Aptos and Sui saw double-digit declines. Across the board, more than 600 million in leverage positions were liquidated, according to Coinlist's data. The sell-offs began in Asia during early trading hours and quickly spread across global markets as panic set in. So, what caused this? The first clue lies in massive on-chain movements. Analysts noticed that just hours before the crash, a few wallets associated with large exchanges, primarily Binance and Coinbase, transferred hundreds of millions worth of stablecoins like USDT and USDC to various trading accounts. At the same time, a series of sell orders started hitting the books across multiple exchanges, particularly targeting Bitcoin perpetual futures contracts. This is a classic signature of a coordinated sell-off, not random panic. Someone or a group of entities likely triggered cascading liquidations intentionally to shake the market and accumulate cheaper assets. Another major factor was whale manipulation. On-chain analytics firm Look'n'Chain reported that one particular Bitcoin address, linked to a wallet active since 2018, sold over 400 million worth of BTC within a 2-hour window. This single event triggered a domino effect as algorithmic trading bots detected momentum shifts and began shorting positions aggressively. Once liquidation thresholds were breached, the sell pressure compounded, leading to the Ninocene wipeout. Whales have done this before. It's a tried and tested playbook: push prices down, liquidate over-leveraged retail traders, and recumulate the same assets at discounted prices. However, market manipulation alone doesn't explain the timing of the crash. It happened just days after the U.S. Securities and Exchange Commission (SEC) hinted at investigating several major exchanges over unregistered securities trading. At the same time, reports surfaced that the Federal Reserve might delay interest rate cuts due to persistent inflation, bad news for all risk-on assets, including crypto. When institutional investors sense macroeconomic tightening, they often pull out liquidity from volatile markets first, and crypto usually takes the biggest hit. This means the Ninocene crash may have been a perfect storm of both manipulation and macro uncertainty. Then there's the ETF connection. Bitcoin ETFs have been one of the biggest bullish narratives of 2025, bringing institutional money into crypto at an unprecedented scale. But recent data shows that ETF inflows started slowing down last week. Some funds even recorded net outflows, suggesting big investors were rotating capital out of crypto, possibly ahead of expected market turbulence. When liquidity providers and institutions reduce exposure, retail traders often get caught off guard. This may have been the smart money's exit right before the crash hit. There's also growing speculation about the involvement of offshore trading desks and Asian market makers. Multiple blockchain intelligence reports suggest that a large chunk of early sell pressure originated from wallets associated with Hong Kong and Singapore-based trading entities. These firms are known for using advanced algorithms and deep liquidity pools to front-run market movements. The theory goes like this: these desks coordinate to create sharp price swings, exploit liquidations, and profit from volatility. In other words, they profit whether the market goes up or down as long as retail traders are reacting emotionally. But the mystery doesn't end there. Some analysts believe that the crash may have been triggered by internal exchange issues. A few unconfirmed reports suggest that one of the smaller exchanges suffered a major liquidity crunch or even a hack, forcing it to liquidate large amounts of assets quickly to stay solvent. This could have spilled over into broader markets, especially if large positions were tied to shared liquidity pools or derivatives platforms. Remember, crypto markets are hyperconnected. One major sell-off on a single exchange can cascade globally within minutes through arbitrage and automated trading systems. So, who is truly behind the Ninocene crash? While it's difficult to pinpoint a single culprit, several players seem likely: whales and market makers deliberately manipulating prices to flush out leveraged traders, institutional investors strategically pulling liquidity amid economic uncertainty, exchanges or funds under distress forced to sell large holdings, algorithmic trading systems amplifying downward momentum once volatility spikes. Each of these actors played a part, but the end result is the same: billions erased from the market and retail investors left reeling. Yet, beneath the chaos, there's always a pattern. Historically, major crashes like this one have preceded massive accumulation phases. The same thing happened in 2021, 2022, and early 2024. After large liquidations, whales often quietly rebuild positions while sentiment is low. As fear dominates headlines, smart money prepares for the next big move. Interestingly, blockchain data is already showing early signs of accumulation. Large wallets have begun moving stable counters back onto exchanges, a typical precursor to buying activity. Bitcoin's exchange inflows have decreased sharply, suggesting that selling pressure may be tapering off. Meanwhile, Ethereum's staking deposits have increased slightly, indicating that long-term holders are still confident. All of this hints that the Wannabe crash might have been less about destruction and more about redistribution, a power move to shake weak hands out of the market. But make no mistake, this crash is also a wake-up call. It exposes the fragility of crypto markets, the dominance of whales, and the lack of regulation that allows such events to happen repeatedly. While decentralization is crypto's greatest strength, it also means that no one is truly in control when panic sets in. Retail traders need to understand that the same volatility that offers 1x returns can also erase 90% of a portfolio overnight. Education, patience, and long-term conviction are more important than ever. Looking forward, analysts remain divided. Some believe the crash was a temporary shakeout and that Bitcoin could rebound strongly in the coming weeks, especially if institutional inflows return. Others warn that this could mark the start of a broader crypto correction, potentially pushing BTC back toward the $50 region before stabilizing. Ethereum's price structure also looks vulnerable unless it holds above key support zones. The next few weeks will be crucial to determining whether this was merely a manipulation-driven event or the early signs of a deeper market reversal. For traders, the key now is not to panic. Historically, markets recover from such events faster than expected. The same whales and institutions that caused the crash often re-enter the market quietly once prices stabilize. This is why seasoned investors always say be fearful when others are greedy, and greedy when others are fearful. If history repeats, the aftermath of this crash could present one of the best accumulation opportunities before the next major crypto rally. So, what can we learn from the Ninissing crash? First, always watch on-chain data. The blockchain never lies. Large transfers, exchange inflows, and whale movements can signal what's coming. Second, avoid excessive leverage. The majority of losses during this crash came from traders using 1x or 2x leverage, who were instantly liquidated. Third, diversify and hold long-term. In every cycle, the market rewards patience. Those who held through 2020, 2022, and early 2024 saw tremendous gains despite temporary chaos. Finally, remember that crypto is still a battlefield between retail investors, institutions, and whales. Every crash, every manipulation, and every rumor serves one purpose: to transfer wealth from impatient hands to patient ones. The Ninissing crash may look devastating today, but in hindsight, it could be the event that resets the market and prepares it for the next wave of adoption, especially as 2025 unfolds with the Bitcoin having narrative, new blockchain innovations, and expanding institutional interest. In conclusion, the Ninissing crypto crash was not random. It was likely a calculated sequence of events involving whales, exchanges, and institutional players responding to macro triggers. Whether this marks the start of a longer bear phase or just another shakeout before the next leg up remains to be seen. But one thing is clear: the game has changed. Those who understand the power dynamics at play will survive and thrive, while those who chase short-term hype will continue to be victims of volatility.